Joining us today is Ian Gilbert, Head of Retail Regulatory Policy at Australian Bankers Association, who will be speaking at IIR's Retail Financial Services Forum 2010, taking place on the 23rd to 24th of August in Sydney. Hello Ian, thanks for joining us.
Yes, good morning James. Thanks for the opportunity to go live.
What level of risk is acceptable for retail banking clients?
Look, I think this is a two-way thing. Both borrowers and banks, for example, in a consumer loan, have their own risks to determine. Obviously, a bank must undertake its own risk assessment of the customer and also its appetite for risk and price that accordingly. And of course, the bank assessment is that its risk is that the customer may not repay the loan. I think a recent example with the new consumer credit laws will help give a bit of context to this. A bank is going to have an additional risk of ensuring that it complies with responsible lending obligations or face the possible loss of its ability to recover the loan. And under the new laws, the customer is largely relieved of the borrowing risk because of these responsible lending laws. So, while a customer is free to decide what level of risk the customer wants to take on, for example, with a residential investment property loan, it's the bank that must not enter into a credit contract with that customer if the contract is not suitable for the customer, either or both because the contract doesn't meet the customer's requirements and objectives, or because the customer's ability to service the loan is questionable. So, with the new credit laws, they shift the balance of risk quite significantly onto the bank. The bank must make its own assessment of the risk the customer presents, but also must make sure that the customer doesn't, in making their own judgment, enter into a contract which they may consider might be acceptable risk-wise, but which the bank is of the view that it is not acceptable risk-wise for the customer. So it's quite a significant shift in the risk paradigm. For non-credit products, there's a scale of investment risk associated with products depending again on the investment risk profile and the appetite that the customer has for risk. And of course we've got products ranging from deposit accounts through to very complex products where the investment risk decision is generally designed to be managed through financial advice provided by a qualified advisor. Here the level of risk is largely a sovereign decision of the investor rather than the provider of the financial service, that is the product service itself. I think the regulatory regime has still to really come up with a workable design feature so that we ensure that only those investors who ought only to invest after receiving financial advice get that advice. And what banks and ASIC have been doing over recent years, of course, is to work on expanding and improving the financial literacy skills of consumers. And that's an important factor in seeking to strike this balance in the risk spectrum.
And what are your thoughts on the convergence of the investor with the consumer in the current regulatory environment?
Well, they can be both consumers and investors, and vice versa. Perhaps if I can go back to the new consumer credit laws again, we've seen for the first time the coverage of individuals who want to borrow for the purpose of investing in residential property. And the same regime covers them as will cover people who are just borrowing to buy a home. The same protection rules apply, effectively irrespective of the purpose for which they are borrowing. There's one aspect in this new law which is quite interesting, and it goes back to the point I was making earlier about getting a balance into the spectrum of sophistication of people wanting to invest or borrow money. And that is that an individual who borrows to carry out a major residential investment project, such as building a retirement village or a block of apartments, is going to receive the same level of protection under the new consumer credit laws as a mum and dad investor buying an apartment as an investment opportunity. So no matter how experienced or skilled or financially literate the individual is, on the spectrum from someone who's building a retirement village as an individual, not as an incorporated entity, they're going to be covered to the same degree under the consumer protection law as a less sophisticated first-time property investor. This one-size-fits-all approach is probably good in one sense, because compliance programs can basically apply the one-size-fits-all in a seamless way. But what we need to make sure of is that the one-size-fits-all doesn't translate into unsatisfactory consumer outcomes and expectations. And you can imagine that arising where there is a sophisticated property developer who's really not interested in the type of protections that might be more appropriate for a less sophisticated investor.
You're speaking on a panel at IIR's Retail Financial Services Forum 2010, which takes place on the 23rd to 24th of August in Sydney. What do you hope to address at the event?
Well, first of all, I'd like to just thank the organisers for inviting me to participate on the panel. I suppose in any forum such as this, it's a great opportunity to progress and broaden understanding of regulatory issues that face the financial services sector, and to ensure that sound principles of regulatory intervention are applied in substance. And for me also, it's an important means of getting feedback from delegates at the forum on how they see the world.
Ian Gilbert, thanks very much for your time today.
Thank you very much.